So terminologies. What are the terminologies and lingo that we use in the Forex market? So terminologies are quite simple. Many people make it look quite complicated, but they are very, very simple. It's just words that we use in the Forex market, okay? So long. Long is the process of buying a certain currency with the when the price is low, with the expectation of it to appreciate in price. So basically, when we think, for example, the dollar is going to rise and we want to buy that, it basically means we are going long on the dollar. Okay, so whenever you hear long, it basically means we're buying that currency. Short is the opposite. Short is a process of selling a certain currency when the price is high, with the expectation of it to appreciate in price. Okay, so basically, let's say the dollar is at a high price, or things like Bitcoin and all that, and we expect it to fall. We basically call that short selling, or going short that pair. So whenever you hear someone saying I'm short, they're basically selling that currency they're talking about. Bull. So as you can see with the image behind, a trader who believes that price of a given currency will move higher in price is called a bull. So any speculator or trader who believes the market is going to go long and they want to buy, they're basically called bulls. So these are the bull traders. They're basically buying the market. So bulls are normally looking to charge the market to a higher price. The opposite of that is bear. So a trader who believes that the price of a given currency will move lower in price is called a bear. So any person who's looking to go short a market, basically to sell the market, is considered to be a bear. Okay, so whenever we're talking about long and short, it basically means we're talking about the market. Whenever we're talking about bull and bear, we're talking about the traders who want to participate in that market. Okay, so I'm sure that's clear. Lot. A lot is the standard size of a contract or position that the broker can allow you to take depending on what type and size of account you have. So don't think this is complicated, you'll get the hang of it, but basically this is what a lot means. If you break it further down, lot sizes are broken down into standard lot, which is basically 100,000 units, so $10 per pip. We'll get into this, so don't let it confuse you. Mini, which is basically 10,000 units, $1 per pip, and micro, which is 1,000 units, which is $0.1 per pip. So we'll get into these lot sizes and the different lots that we have in the Forex market. Bid and ask price. In the Forex market, there are two prices on a currency pair given at any one time, known as the ask price and the bid price. Okay, so the ask price is the price by which a certain pair is being sold at a given moment, and bid price is the price at which the pair is being bought at that same given time. So these are prices that are normally quoted at the same time, depending on the pair. So the ask price is basically, if we take the lingo from auctioneers, so anytime someone wants to buy something, so whenever an auctioneer is selling something, they normally bid the price. So they say, we are bidding this for, let's say, $1,000. Someone else will come and say, I bid $2,000. So it's basically the bid price, the price at which a pair is being bought, the price that someone is selling. And ask price is basically the certain pair which is being sold. So the price that now the seller is asking for. So that's the ask price. So what price are you asking for? So the people who are bidding will come and ask the broker or the auctioneer, what's your asking price? That's basically the price at which the person who's holding this certain thing they're selling are selling it for. So what price are you asking for? And for me as a buyer, what price am I willing to bid for? If you're selling at 1,000, I'm bidding to buy it at 1,500. So I'm sure you understand the gist of that. Using EURUSD as an example, this is what you get. So ask price, this is the selling price. This is 1.5320 level, and the bid price, which is the buying price, is at 1.5325 level. Okay, so you want to know the difference. They're normally quoted against one another. So this is EURUSD, what is the asking price, buying price. So if you want to buy it, you'll buy it at that price, and if you want to sell, you'll sell at that price. So if at the moment EURUSD is trading at that above price and you want to buy and be long, you will buy at the 1.5325 level. And if instead you decide to sell, you will sell and be short at the 1.5320 level. I hope that is understood. So spread. The spread is the difference between the bid and the ask price. is known as spread or transactional cost. So the difference between bid and ask is basically known as spread, which is the transactional cost. That's why when you go back and look at this, that's why there's a difference over here. So if you look at this, this is 1.5320 and 1.5325. So this difference, which is 0.0005, if you minus that, that is the transactional cost, or what is known as the spread. Most brokers make their money through the multiple transactional costs per trade. So on each and every trade, you'll normally get a transactional cost traded on any given day. Okay. To get the difference, you subtract the ask price from the bid price, just what I've shown you. So if you do this, and if you subtract the buying price from the, if you subtract the selling price from the buying price, you basically get 0.0005. This is basically the spread or the transaction. We'll normally call that a 5 pip spread. So we'll get deeper into that. This may seem like a small or insignificant amount of difference, but depending on the size of account you have and the lot size per trade, you will get to realize that the 0.0005 is actually a huge difference and quite costly. More on this on the pips section. Leverage. Leverage is the process of borrowing more money than that you have in your trading account in order to trade in the forex market for the sole purpose of making a greater return. Okay. When you leverage your account, it allows you to make a higher profit as compared to a non-leveraged account. This works in the opposite side as well. When you leverage your account, your trading account, you can lose a lot more money than expected. So it's basically, we normally call this a two-edged sword, a double-edged sword, I mean, because if you profit from it, you can make a lot of money. If you lose, you can lose a lot of money. So leverage is quite dangerous, but you can also use it quite good depending on the amount of leverage you're using. And basically, leverage is where you're borrowing more money than that you have. It's sort of like getting collateral from a bank and going to invest with that more money. So that's leverage. To fully grasp this, think of your broker as a bank who basically lends you $100,000 to buy currencies, okay? What the broker asks from you is that you give them $1,000 as good faith deposit, just like taking a loan from the bank, which is kept in an account known as a margin account. So this $1,000 will be kept in a margin account, which is kept in your brokerage account, and the broker is going to give you $100,000 in order for you to transact. So you can take a position worth $100,000 even when you have a small account which hasn't yet reached $100,000. This whole process is known as leveraging and is usually displayed in a ratio. For example, 1:100 means for every $1,000 deposit, so every $1,000 you deposit in your account, you can control currencies worth $100,000 in the market. Therefore, leveraging is basically being able to control large amounts of money with little deposit. An example of a $1,000 account with a leverage of 1:100. So this is basically what it looks like in image format. So I'm just trying to explain it to you so that you can understand it much better. So you can see on this hand, whenever we have 1:100, okay, so for every $1,000 kept in your margin account, which is a small amount, you can get a bigger account volume of 100,000, which is basically 1,000 times 100, and you're able to trade this. For example, let's say your leverage is 1:50. That means you'll have $1,000. For every deposit of $1,000, you can control $50,000 worth of units in the market. So more on that later, you'll get to understand it. So as I'd earlier mentioned, margin account. Margin is a specific percentage of your account that the broker keeps once you execute a trade. So that leverage kept in your margin account is what we're talking about. This is the margin. It is a good faith deposit that a trader puts up for collateral to hold up or open a position. So basically, like what I said, if you want to go buy land and you don't have that enough money, but you want to use the bank, basically the bank, let's say the land is 5 million and you have $1 million. So that $1 million is your collateral. You'll put the $1 million down payment and they'll give you the rest and you'll pay it slowly. But margin is basically that. So you open an account and there's that collateral hold by the broker in order to have your trade running. Upon each trade executed, Okay, the broker will set a specific amount aside as long as the position is open. Okay, so the broker will always take a certain margin. If your equity or equity trading account balance decreases below the margin, you're going to get a margin call. Okay, so a margin call is basically when you're losing a lot of money and the amount of money kept, let's say you have $2,000 account, $1,000 is kept in your margin account, and now your money that is left running is about 1,000. So if that 1,000 equity starts dropping below the money kept in the margin account, you'll get what is known as a margin call. So trust me guys, you don't want to be getting a margin call, because this is basically what we call blowing your account, losing all the funds you have in your account. So as I said over here, margin call. A margin call is when a broker calls you to tell you that you need to put more money in your account in order for your trade not to be closed, because your losses have become a large for your account to handle. So your losses are too much. It's, for example, let's say you take some loan from a company, you go start you take a loan from a bank, you go start a company, and your company is just making losses, and you're not paying the bank the amount of money you need to be paying them every month or what you had agreed. So basically they'll come to you and tell you, if you don't give us money, we're going to take everything. So that's basically now in Forex. Now use that analogy, it's what we call a margin call. So you do not want to be getting a margin call. Here at Financial Hub, we try and teach you not to be able to get these calls, and we teach you by proper risk management. Hello traders, you have just completed the basics of Forex trading. To advance your trading career, you need to learn advanced technical analysis, risk management, and the psychology of trading. So buy our legendary advanced course and develop these trading skills. As a legendary student, you will get one-on-one access to our mentors, a copy of our course book, over 30 hours of trading content, and you'll get funding of $1,200 to kickstart your trading career. So click the links below to begin.